Welcome back to the channel. Mo again at ATZ Finance. And this week we're sitting down with Nilesh, one of the founding partners of ATZ Finance. We're hoping to learn more about what it takes to grow your business. There's never really a wrong or right time to grow a business, what that entails, the challenges that may come up with it, and how maybe commercial finance can support those challenges. So look out for more information on the commercial finance industry from us. That's Mo at ATZ Finance. So talk to me, man. How are the last couple of months been for you in the commercial finance world? What's been new? What's changed? What have you enjoyed?
Traditionally, I said most businesses may come across the same way. December was quite a quiet month. It's
Oh,
just
yeah?
people are winding down. They'll deal with it in January, and in that sense, people just enjoy their time off. You work, you have a business, you kick back, you stop for a bit, and now January's come back in again, and it's all guns blazing kind of scenario. And from that point, I mean, all the inquiries that were pending tail end of last year are now coming to market. All the decisions they've made, all the resolutions they've made about their businesses, where they want to be for 2026. Now's the time to do it, because we're literally halfway through January now. The longer you leave it, the longer it's going to take to get sorted out.
Absolutely. Do you know, just on that point there, right? You mentioned the seasonal period was a little bit quiet for the commercial finance business, right? I know that some businesses are quite seasonal where the Christmas period or the end of the year can be quite busy. So similar to how there's different seasonal businesses, does cash flow reflect that as well?
Definitely. So if you're a seasonal business, you're relying on a peak and a trough, aren't you? So you could be 3 months out of the year where you make your revenue for the next 12 months or 9 months out of it. And other businesses work for 9 months, take 3 months off, depending how the business works. So it comes down to a cash flow scenario. It's not that business is not profitable or not sustainable. It's just they have peaks and troughs. And how do they ride the wave out for the 12 months to come through? And that's where certain products, services, conversations start to arise. You've had a great January, say November, December, January, if that's the kind of, if you're in hospitality or some sort of sector. But then come February, that market dies down a bit. There's a reason why January is so quiet in hospitality. Everyone's done everything in there prior to that. So how do these guys keep their lights on? Their bills are still coming through every single month, right?
Yeah, absolutely. Yeah.
So it's not like they're a bad business or a challenged business. They just have a business with cash flow challenges.
Right, right. And what's the difference between, so you know, when you bring up the word cash flow challenges, right? Automatically people think, oh, I've got cash flow challenges. I must be running a bad business or I'm not good at business.
It's that negative income. It becomes that negative vibe. People think that if I mention the word cash flow or cash flow problem, my business is not profitable, it's not sustainable, it puts you on your back foot. But if you look at any business out there, they've all got cash flow challenges because money's coming in as equally as money's going out again. So they need to find a fine balance of when your clients pay you and when you pay your suppliers. So for example, you may have 30-day terms with your suppliers. So you get the product delivered today, but then you sell it to your client 3 or 4 days later, but they're on a 30-day term as well. So the cash flow scenario is that gap in between. By the time they've paid you and you've paid your supplier, there's an overlap of 3 to 5 days, potentially, if the source is being sold at the right time, right? How do you bridge that gap in between? You can't be late to pay your supplier, then you lose your line of credit, right?
Right.
So how do you bridge that gap? And that's where people come to us to work out solutions.
All right. What kind of products have you placed in those type of cash flow
So that one
challenges?
would be a simple invoice finance deal,
Okay.
or you take a short-term working capital loan based on the products coming through. So you literally just borrowing the money for a very short period of time, sometimes a month, 3 months. It all depends on the product cycle. So something like that would be an invoice finance deal, working capital loan, just a straightforward VAT loan potentially, because you might be utilising some of your VAT funds to help cash flow your business.
Okay.
Because that money's sitting in an account. So most businesses, VAT comes, the sales made, VAT comes through on top of that. At 20% on top, they park it in a different pot or a different savings account. Sometimes you dip into that pot to help that cash flow problem in between. But then it becomes a stage where you're moving the same amount of money around. It becomes a balancing act. So it's like that scenario when you go to the circus and the guy's juggling those plates, right? The plate spinners. They can spin 2 or 3 plates really well. The fourth one goes on board and the other 3 potentially start to topple, right?
Yeah, absolutely.
So they put the 5th one on there, which is a new client they've won, and the whole thing goes to pot. So what we do is that 5th plate that's spinning, we help fund that. And now the client's only focusing on 4 that he has to worry about.
Interesting. You know, I'm sure that's a scenario that most business owners will be able to relate to. That is a really good example.
Definitely. So it's all about how can you make the client or our potential client breathe better? How can they work themselves? And it kind of boils down to a scenario where people get into business to get out their comfort zone, right? Like you're in business as well. if you're running a business, are you in your comfort zone every single day?
No, probably not. No.
Your employees are, right?
Yeah.
But you're not, are you?
Yeah, exactly.
There's times where you're working numbers out, you're crunching things, you're looking at, okay, how do I fund the next 3 months? So you're looking at cash flow, money coming in, money going out, turnover, profitability, all those kind of things, right? So as I was talking to a client about the same situation, is how can you get them out of their comfort zone? And what I mean by that is you come out of your comfort zone and you ask for help.
Right.
So this is the key thing here.
Okay.
You come out of your comfort zone and you ask for help, and help in the sense of, okay, I need some liquidity in my business. How can I leverage what I've got within my business already and get some more money in to help cash flow this out? You don't do it indefinitely. These are that's why they call it short-term loans.
Right.
It's not like a mortgage where you tie it for 25 years or 15 years. That's a long-term debt, which we'll cover later on. These are short-term debts utilized literally for a short-term product, for a short-term need, and just to get them out of this short-term place.
Okay, so look, you mentioned coming out of the comfort zone, right? And do you think using products like invoice finance or utilizing small business loans is an example of coming out of the comfort zone? And what is it about using these products that people really, kind of shy away from or feel uncomfortable with?
Okay, so it's misconception of, and this is where it becomes a misconception of how people think debt should be managed.
Okay.
So there's two types of debt, yeah? There's good debt and there's bad debt. Good debt is like your mortgage, something secured against an asset, something that's making you money again or growing with capital appreciation.
Okay.
Bad debt will be you go out for dinner, you spend 200 quid on a nice steak dinner, for example, and then you haven't got the money to pay for it, so you borrow on a credit card. But you're paying that debt back over a 3 or 4 month period because that's the way you've cash flowed it. Or you buy new clothes or something of those, which is an asset that doesn't make you money
Okay.
or growth. So that's kind of a way of bad debt. But a lot of people utilize that in their personal life because they'll go on holiday and they'll pay on credit card, but then they'll pay that credit card off for 12 months. And that's perfectly sustainable. And it's perfectly achievable and it's perfectly sustainable, right? Or at the same time, how can you do that slightly differently? And what I mean by that is business, people are scared to ask for help. I would say a good 90% of my clients, and probably most people watching this video would agree, that they've been told to run a business, cash, no borrowing, no liquidity, don't take anything from anybody, run it as it is. Money comes in, money, only spend what you've got.
Yeah.
Right?
Absolutely.
We've heard it all the time, haven't we?
Yeah.
But then why is it in your personal life, you're told the opposite? Borrow, borrow, borrow. Get a 0% credit card, borrow the money here, live the life you want to live, live your dreams, live your aspirations. And that's it boils down to that first point I made about comfort zone.
Right.
So you're comfortable getting out of your comfort zone in your personal life, but you're not comfortable getting out of your comfort zone in your business life.
Interesting. Very interesting. So what you're saying is personally people are more open to the idea of debt and credit cards and using mortgages and these things, but
Not mortgage, I say even just unsecured loans.
Right.
Because it's normal, it's normalized. In business, people have not come to the mindset that it's normal to borrow. It used to be 10, 15 years ago. Everybody was buying invoice financing, factoring, everything, every angle you could possibly borrow, people borrowing.
okay.
And now why are people scared to borrow on their business? There's a number of reasons why. And I'd like to hit the nail on the head on the beginning on this one. One, the market's changed and evolved since COVID. And what I mean by that, people are asking for simple things like PGs, personal guarantees. Now, if you don't believe in your business, should you be in business?
Yeah, absolutely. Should you? Yeah, exactly.
All right.
Yeah,
So
true.
and that's why the personal guarantees are, during the COVID period and during all these.
So just tell us a
markets.
bit more. What is a personal guarantee?
So a personal guarantee is where the lender will ask for a bit of security on your behalf. So
Okay.
if you borrowed a £50,000 loan and you're a homeowner, you sign a personal guarantee.
Right.
That if the business was to fold or liquidate or close down, you can still service that debt back again. You're
Okay.
kind of liable for it. How they chase it is the lender's discretion. Sometimes they write it off if you try to service it, depending on the circumstances involved. But they just need to know, okay, if we're going to commit to you, are you committing back to us again? If it's secured against an asset, there's still a personal guarantee involved, believe it or not. It's just another element of security.
So going forward, do you think personal guarantees become more of the norm in the market?
It's standardized now.
Standardized. Okay.
It's literally, if you'll do a personal guarantee when you sign a lease to buy a building. Or when you rent, most business, when they rent a building, the lease in their business name. And then you pay your rent on to go with it. But there's always a personal guarantee involved.
Interesting.
So if the business folds, you're still liable for that rent anyway.
Of course. Yeah. Yeah.
So there's got to be an element of, it's just security, stability, and the lenders want to feel a bit protected.
Right. And you think from a client's perspective, right, it's important to see that everything's transparent. There is, security on the lender side, security on the client side. It's important to see both sides.
Of course. Then I said they've got to be, they've both got to be aligned.
Right.
They've both got to be aligned, right? And a simple way to explain to the client would be, okay, if this was your own money, would you lend it to yourself without this guarantee? And then they're always trying to say, no, I need to be protected.
Of
And that's how
course.
the lenders look at it. It's not that lenders want to be difficult. They don't want to screw you over. They want you to succeed.
Yeah, so clients should be happy that there's protection and security there on both sides,
Of
right?
course. So imagine working with a lender that doesn't care, just gives you the money willy-nilly. The rates are all over the shop, and then they can call that debt in whenever. There's no stability. There's no control. So as much as they want to be in market to lend money,
Okay.
they've got to be in the market to protect their income as well.
Yeah.
Otherwise, why are people in business?
Okay, so look, going back slightly to what you said about the being in your comfort zone, right, when it comes to business, and how, exploring more finance options is essentially coming out of your comfort zone, right? Do you think part of that reluctance that clients face when it comes to approaching someone like yourself who does commercial finance and deals in loans and debt, do you think part of that is due to maybe the education, maybe the knowledge? There's a knowledge gap, they don't really know too much about it, so people tend to shy away from it?
It's definitely a knowledge gap to go with it. It's definitely that. There's an element of the market tells me I can't borrow.
Right.
My friends told me down the pub, you shouldn't borrow. But these guys don't run businesses. If you hang around with the right peer group, you look at any successful business, for them to scale, they've borrowed. Why do venture capitalist funds exist? Why do private equity funds exist? Why does Starbucks go to a private equity company to scale? They're one of the largest companies globally, right?
Yeah,
In terms
yeah.
of coffee manufacturing, you cannot get bigger than, at one point they were everywhere, weren't they?
Yeah.
But they borrowed to scale.
So as we know, right, debt exists quite commonly in high finance, right? So some of these bigger entities you mentioned, private equity, investment banking, a lot of these debt is pretty much standard practice, isn't it?
Yeah.
But we're not seeing that in the small business market, is what you're saying.
Because it boils down to comfort zone. The small business owner is uncomfortable borrowing money. And I would say because they're scared how to make those payments. They're worried about the commitment every single month. They're worried about being liable on something else. So they'll thrive to grow their business. But you give them a loan or a payment due every single month. Now they're like, oh, I'm going to pay for it. Now they've got a sense of responsibility for that business to work.
Okay.
They've got enough money to pay for their rent. And I'm not saying this is across the board for every business, but this is where the biggest catalyst problem sits. I reckon the last 5% of a decision-making process, this is the bit behind it.
Right.
Do they actually believe in what they're doing?
Okay, interesting. So essentially, would you say more of your time is kind of taken up with advising clients on these kind of issues? It's not just a case of client comes in, you look at what's there, and then you just go for the loan. You sit down, you consult with them.
Of course, because each lender has their niche point where they're working with. So each lender will have, each client falls in 3 or 4 different brackets. You get your tier 1, squeaky clean, perfect, who can get the credit all day long, but they don't necessarily need it, but they like to have it.
Okay.
So for them, it's their comfort zone is having the ability to have a facility or a credit line available when they need to dip into it.
Okay.
Then you got the other side. This is when the clients are quite established. They're halfway through their business journey, top of the food chain. They're doing really, really well. They don't necessarily need it, but they like to have it.
Okay.
So if they do want to go into another venture or expand or grow, they've got the opportunities there. At the same time, you've got business that's starting off in the beginning, who need the liquidity, who need the borrowing, who need the cash to grow their business, but they can't get it funded.
Okay. So with those startup businesses you mentioned, right, is there any way you can help them?
There are a couple of schemes out there, but for these schemes to work, there's got to be an element of business plan, cash flow projections, growth, what type of business they're in right now.
Right.
Is it a sector they've already worked in, or is it a new sector? So we've got to build a business case. Pretty much the same way you used to build a business case when you work with your bank manager in the olden days. You'd go in, you sit down, give them a business plan. So our lenders require the same thing. And what changes the post on this whole equation if the client can put some sort of security down.
Okay.
So this is traditionally a startup would require a homeowner PG. So the lender would give you either a debenture or a charge over your own primary residency. This is not trying to scare people that, they'll take everything if it goes wrong. They just need to know, okay, you're starting a business right now. You're an injection of cash. We'll give you the money, but give us this bit of security. And after 3 years, you can take that security back off again once you've paid it back or made good with it. And they can remove that charge off you, but you need to bring something to the table.
Okay. Interesting. And what are the challenges you see with clients that maybe don't have security? Is there any way that anyone else, they can still get borrowing?
They can, but it all depends on the business they want.
Right.
So a lot of startup companies come to me saying, okay, we need some money to grow our business, to start a business. Okay, what do you want the money for? Advertising. So we're trying to put money into something which is non-tangible.
Okay.
So when you're starting off a business, what's the first thing that you really need? It's not advertising. People think you need to do these Google AdWords and get these websites, all these kinds. You need a product that's sellable,
Okay.
or a service that's sellable, right? Once you've established that, then you can start building back from. What is your business or your idea or your restaurant, or what does it need to survive with? And if it's let's use a restaurant, for example, or a takeaway business. What's the first thing a takeaway or restaurant requires when they're starting up?
I would say maybe kitchen equipment.
Right. So what's more important in that scenario, kitchen equipment or marketing plan?
Exactly.
Right.
yeah.
So let's finance the kitchen equipment.
Right. Okay. So what you're saying is where maybe the finance wouldn't be suitable in a cash flow scenario for marketing purposes when they start up, it is maybe possible for something else like an asset.
Exactly. Now an asset, there's something tangible against it. So if you can secure the debt against something, it's an easier way to get it through, because the lender now realize, okay, I'm funding a fridge freezer or a kitchen or a range of worktop or fixtures and fittings within this business right now. So they help you do that. Something like that, you put 10%, 20% deposit down, the lender will give you the rest.
Interesting.
There are schemes out there that help you leverage startup businesses. Things like the GGS scheme, the Guaranteed Growth Scheme, government backed, but the lender needs to broker the deal in between. They won't give you all the money. Now, a lot of the misconceptions that people think you can go to the Guaranteed Growth Scheme and they'll just give you 50 grand willy nilly, like the COVID bounce back loans. Doesn't work that way anymore now.
Really?
100%.
Okay.
Not. But the mindset is still there. I've got a business, I can get a loan. No, now they need to know why they're giving you the money. A lot of defaults, a lot of bad debt in the marketplace. There's a reason why these things will come into place, is because the good debt versus bad debt, from a lender's perspective, not everyone paid it back.
Okay.
So now they've tightened the rules up. So they didn't want to, but they had to. So there's work back from there. So back to the restaurant trade, we can look at things to finance within that business. So that's one aspect. Now your restaurant may also want to buy a little van to do deliveries with. Door to door, it could be a little greengrocer or something. So you can now asset finance the vehicle. Could be a van, a truck, or a moped or something.
Yeah, I was gonna say, if like rather than a restaurant, maybe if your trade starting out as a plumber, electrician.
Yep.
You know, if you're maybe doing deliveries, there's a lot of independent delivery drivers out there as well, right?
Yeah.
That have their own
They've
vehicle.
got Yodel contracts, DPD.
Yeah.
But these guys have contracts they're making good money a day, right? But they don't have the money to buy a 30 grand van. So a £30,000 van you can buy on an asset finance.
Really?
So
Okay.
a brand new, give an example, we done a deal last week for a Ford Transit. Long wheelbase, usual spec to go with it. 25,000 plus VAT.
Okay.
Simple van, does the job. Managed to get the client a VAT deferral. So what that means, you don't pay the VAT up front, you pay it after 3 months. So by the time you registered it with the HMRC, you put your claim in, you kind of all balance out for cash flow purposes more than anything else. And they get the van with a 10% deposit.
Oh wow, 10% deposit.
10%. Sometimes we've done deals with zero deposit.
Really?
But it all depends on the client. If it's a startup, they'll ask for a small deposit up front. But because this is a tangible asset, something that holds value, that after 2 or 3 years, you have an asset in your business which is going to make you money.
Yeah.
So this is good debt. So you'd borrow money on that.
Because what you're saying is, okay, so they've gone and borrowed money to purchase a van. That van now sits within the business, and that van goes out and
Make some revenue every
makes
single
them
day.
revenue. And as long as that revenue that the van makes exceeds what the monthly
payments are.
payments are, then that's good
Definitely.
debt.
So the van will make you an income of XYZ a month. From that, you deduct your running costs for the van.
Yeah.
You deduct your fuel, the finance cost, and then that's the rest of it's all profit.
Interesting. Okay.
That's where this is now a tool that makes you money. So this is a good asset.
Right.
This is a good debt and a good asset which is making you money.
And what about scaling something like that? Let's say we were to do something like that. Let's say someone out there listening maybe has a delivery company, or they want to buy a van. What's the scalability on something like
Something
that?
like that will get you set up with a line of credit. So what that means, okay, look at your current structure. This is more from that scaling perspective. These businesses are set up with already 1 or 2 vans. They've got a year's trade under their belt already. So now they're in the second or third year of trade.
Okay.
So at that point, how do we scale? So at that point, we go to a lender and we're giving a line of credit, say £130,000 or £150,000. That's going to be enough, equivalent to 6 or 7 vans. So now they know the line of credit's there, and they can buy vans as and when they need them now.
Okay.
And that's the benefit. So we give them that stability. They can go into that facility over a 12-month period and scale up from there.
Interesting. So look, talking about scaling, right? There's obviously different challenges in business. least of all is obviously starting the business, getting it up to a level where it's, making money and it's breaking even. After you've reached that phase, essentially all business owners have the ambition to scale their business. But coming with scale and, getting more contracts or whatever it is growing a business comes with challenges, right? One of those challenges tends to be cash flow. So can you talk to us a bit about how maybe you see invoice finance helping in a scenario like that?
Invoice finance, factoring, or you just how to get more liquidity into the business. And that simple thing like that could be a VAT funding, your
Really?
insurance, your PPI, for example. You're a law firm,
Okay.
your PPI insurance is in the hundreds of thousands. How do you offset that?
Mm-hmm.
Do you pay? All these policies require to be paid up front? A delivery driver company, say DPD or any logistics business, their fleet insurance could be in the hundreds of thousands of pounds, and that's due up front.
Yep.
So how do you now tie up that much money on one policy?
Mm-hmm.
But you need that policy to trade, so it's a business critical requirement.
Right.
So you've got a policy for, let's make numbers nice and simple, £120,000. So either you pay £10,000 a month plus interest, and you saved £120,000 of cash flow. So that money sits back in your account again and utilize it for scaling.
Mm-hmm.
Do you A, get 2 or 3 more drivers on board? B, get 2 or 3 more vans? C, buy bigger premises,
Mm-hmm.
more staff, utilize that money differently. But you've got money coming through the door every single month because you've got these contracts.
Mm-hmm.
So money's coming in via various forms of income.
Mm-hmm.
But your clients don't pay you 12 months up front, do they? They pay
course
you
not.
on delivery or when the product's done.
Absolutely. So if they're not paying you 12 months up front, why should you be paying 12 months of insurance up front?
There you go. So now how do we utilize your lump sum payments?
Mm-hmm.
So there's a reason why your electricity bill is paid monthly or quarterly.
Mm-hmm.
They don't bill you end of the year.
Because people get paid monthly, right?
People get paid monthly, right?
Okay.
Your personal mortgage, you may have a mortgage, you may be paying X, Y, Z a month. Why do your lenders charge you monthly and not say, okay, you borrowed 300 grand for this house, pay us up front after 12 months? They give you the ability to pay it back in stages. They make it palatable.
Right.
They make it easy. And this is where businesses need to understand this concept as well. How do you make it palatable? How do you make it easy? How do you make it digestible? More than anything else. So therefore, do you borrow pay a bit of interest, but offset certain things to give you the liquidity that you need already, even though the money's coming through the door?
Mm-hmm.
How do you give yourself breathing space? You don't use it all the time. Maybe 1 or 2 invoices that you do, or 1 or 2 big policies that you offset with. Then you can grow the business from there.
Okay. I mean, let's move to a topic where finance is maybe a little bit more welcome, right? And that's the property sector.
Yeah, that's
Right.
that is a beautiful sector to be in.
Okay.
And the only challenge with that sector, it's a rate-driven market.
Okay.
What I mean by that, everyone wants the best deal, the best rates, the best product. But it also boils down to the deal.
Okay.
What's suitable for the client.
Mm-hmm.
So what I mean by that, one client may be suitable for, let's take bridging, for example.
Right.
One client may be suitable for a bridging product at 0.79 because they meet the criteria for that client, for the lender. A lower LTV, the asset doesn't need any work doing to it. It's a straight in and out deal. But at the same time, you could have a bridging product where they're charging 1.3 because the client's got adverse history or there's something wrong with the asset. It's a distressed sale they need to complete within a couple of days. There's something in the criteria tool that needs to be changed. They want a higher LTV.
Okay.
So the risk is higher. Higher the risk, the more you're paying.
Okay.
So that sector works really, really well. And it's a very buoyant sector right now.
Right.
And it always has been and always will be. Because if you ask anybody in property, they all understand leverage.
Mm.
And what I mean by leverage is how can you borrow to get more?
Mm-hmm.
So why do investors get mortgages? Or why do serial property investors get mortgages?
Landlords, right, as well? Yeah.
Landlords. You don't see a landlord saying, listen, I'm going to pay my property in cash and then I'll buy the next one. I'll save and I'll buy my first house. No one does that, right? We all like the idea of it, but we'll always get the house on a mortgage and then you work off to pay it off.
Of course. I think that's a really easy concept to understand.
It's a simpler looking, but in business, the I explained earlier on, it's the other way around.
Exactly.
I don't want to borrow, but
It's very interesting, isn't it? Yeah.
Right.
Yeah.
because that's traditional mentality that businesses can't borrow. It's frowned upon. If you borrow money in business, is your business surviving or not? Is it a good business because you borrowed money?
Right. And that's what I mean, right? Like it always comes with this negative connotation that if you're in trouble, it's because you're borrowing. If you're borrowing, it's because you're in trouble.
It's down to society, one, and two, the peer group you're sitting with. And I'll explain that a bit more detail, right? Without
Okay.
having to dig at people. And
Yeah,
stuff.
go on, tell us.
Certain peer groups borrow all day long.
Okay.
If you look at these wealth managers, say in the States or certain parts of the world, where people are buying these big consortiums, big businesses, they're always talking about borrow, borrow, borrow.
Yeah, they have a
A
let's say
mindset of
high
leverage.
risk appetite.
High risk appetite, but it's a leverage point of view. If it goes wrong, it's the bank's problem and it's my problem as well. You're going to be big enough where the banks have a vested interest for you to survive. Prime example, the orange guy across the pond,
Oh yeah.
Donald Trump, right?
Right.
He understands leverage better than anybody else does.
Yeah.
Not just in tariffs. That's his new thing, right? That's his new thing right now. We can get to that later on.
Okay.
But in terms of his business acumen, how did he build such a big business empire without understanding leverage?
Do you think he's ever taken a loan out?
He was on the verge of bankruptcy so many times. And the reason why he didn't go through or follow through on this is going back, say, 10 or 15 years. He's been on the verge of bankruptcy a number of times. The reason why he didn't follow through, because the banks had a vested interest. He owed more money to the banks than for them to survive. They had to work through with him. Richard Branson, you may have read his book. He was on the verge of bankruptcy. He had an hour left before his whole business collapsed.
Oh wow.
Because,
Has he ever borrowed money?
come on. How else do you buy jets?
Gotta
How
ask
else
the
do you
question,
scale a
right?
business, right?
Yeah.
Read his book. He talks about leverage and borrowing all the time.
Interesting.
Make it somebody else's problem. By borrowing money, you made it somebody else's problem, not just your problem. So if you did it all yourself, with all the money you've got, and you put everything into it, and you borrowed, and you have to borrow from yourself, don't you? You either borrow it from your own house or you borrow it from friends and family.
Yeah.
But you borrowed it, right?
Yeah. Absolutely.
Why not just go to the bank and get a secured method of borrowing and get somebody else on your team to support you?
Interesting. Yeah, I mean, I think what really comes into play there is people don't really separate themselves from the businesses, right?
No.
They think, you know what, it's my responsibility to put money into the business. I need to borrow, I need to put the money up, right? But there are
My
other
business
options.
is my business, my business, right?
Yeah.
Then we had a podcast about this before. They're two separate entities.
Yeah.
They're two separate things. They're two separate. You're an employee of the business, even though you're a director, but you're still an employee.
Yeah.
The business is a separate entity altogether that needs to build up. But back to the original start of this conversation about the good debt in the property sector.
Okay.
Those guys have understood the concept of separating the two. They're running a business which is bricks and mortar, which is property. And that's why it's easy to borrow against it. You can see it, it's tangible, it's generating an income.
That's it.
Apply the same theory to your business.
Okay.
So buy an asset, say a van or a truck or a plant machinery,
Oven or
a bottling machine, or whatever it would be, even a camera.
yeah,
Right?
yeah, true.
But these guys here, cameras are a couple of £1,000s. So you bought that, great. But now if you asset finance that, you got people coming and doing a podcast and paying for that slowly. So then now you can buy 2 cameras or 3 cameras. That's how you scale and grow.
Interesting. Okay.
Otherwise, you're going to sit in the same concept and the same process, go with it. And landlords, go back to landlords, how they scaled. One landlord traditionally would buy one property, pay it off, and they'll sit on one asset, generating income. But what do most landlords do? Right, I've done this property, I've done a bit of work to it, I've increased the value by 10%. Let's remortgage it out, pull out all my money, I can buy another one, and then another one, and another, and follow the concept through. It takes time.
Right. You know what? I just want to mention here something actually. We sat in a meeting a couple of weeks ago with one of our lenders, and they have a facility which is a bit similar to invoice finance where they'll take your net monthly rental income across your rental portfolio, times that by 5, and they'll allow you to draw that down. And that money can be used for repairs in properties, or it can be used for deposits for future properties.
Because it's generating income.
Yeah.
So all they're looking at is, okay, you've got this portfolio, and your clients technically are your renters or your tenants. So they're generating income. They've got tenancy agreements. So you've got stability there. It's like running a business and having your customers paying you on time. Same process, same principle. But a lender now has seen a gap in the market, and that's what it's about. That's the benefit of working with a commercial broker.
Right.
Is they see the gaps in the market, products and services that the average Joe cannot see out.
So things are always changing. Like this invoice finance facility for landlords, for example, right? I mean, it's beneficial, isn't it? Right? They wouldn't need to go externally to put if a boiler breaks in one of their properties, what do?
What's their option? They have to go into their reserves or take a loan out, right? But if they've got a business like this,
Dip into their savings.
dip in their savings or dip into their cash flow or their reserves, which makes it difficult to manage. It becomes a cash flow problem. But if they've got a facility set up already for them where they can borrow money for repairs, maintenance, expansion, void periods is the big one.
Mm-hmm.
It's just helping them run they're running a business at the end of the day.
Mm-hmm.
People think a landlord is just your average mum and dad who's bought an extra property and they just become accidental landlords. But it's a business.
Yeah, it's becoming more so, isn't it?
It's a lifestyle and a business. You've got full-time landlords who just do nothing but property, whether it's residential or commercial. They're just agents for themselves.
That's it. And it's a business with loads of innovation as well. Things are always changing, right?
Evolution is key. Like in the finance world, evolution is key. I think we spoke about this on one of our very first podcasts. 3 out of 5 people apply for the wrong product.
Oh, wow. The wrong product, right?
The wrong product, right? So imagine you've gone to your bank manager down the road, you've gone to your Metro Bank or your NatWest, or who else lives on the high street now? Barclays or Lloyds, right? You've gone there, I've got a business, I want to do this, this, and this. Oh, we can't do that. Doesn't fit our requirements. And you're thinking, right, how do I do this now?
And that's a case of them applying for the wrong product.
Yeah, because they've gone in, I want to buy a takeaway. Oh, your business plan's not strong enough, or we can't help you fund an oven, or you want to buy a delivery company. Oh, we don't do vehicle finance. You need to go to somewhere else for that. So the client's gone in with a business idea, thinking the bank manager is going to support them. The bank manager doesn't do anything. They're just another job's worth in the process, right?
Right, yeah.
So
yeah.
they'll come to someone like us, if and when they find us, right? Let's understand the case. What do you really want to achieve? What's the outcome? Why do you need this, and what experience do you have? So we'll fact find them, understand the client's requirement, and find the right lender for them. Because even we have to go through 200 lenders. We've got lenders out there who specialise in one aspect of a sale, and other lenders that specialise in a different part of the sale. And the same thing applies with property. There are lenders out there who only specialise in HMOs, houses of multiple occupancy. Or you've got lenders out there who only specialise in first-time landlords, but they don't own their own house. So we had a couple of cases previously where, a young professional doesn't want to buy their own property, but is happy to invest up north. They live in London, work in London, but they want to buy a property in Durham because it makes good rental yield. So high street banks won't give that debt because it doesn't meet their requirements. They're not a homeowner, but they want to buy rental income. They've got no experience how they're going to service it. So there are lenders out there we work with in the property sector who know that this is the gap in the market.
Right.
How do they grow it? How do they develop it? How can they make it bigger and better?
Interesting. And these products are always changing, right?
Constantly. We're learning on a daily basis. We go to webinars, we go to conferences, we go to meetings. There'll be a product out today that didn't exist last week.
Right.
Rate drops.
And vice versa as well?
100%. And it's keeping on top of what's out there.
Exactly. So
And what
that's
the client
why
needs.
people should really just trust you, right? Rather than, it's hard for someone in business to keep on top of their own business and what's happening in the market, interest
Exactly.
rates, so forth, lenders, so it's better to just come someone that has all that knowledge, all that information,
Yeah.
and that can guide them through that process.
Or choose what's right for them at the end of the day. Because you're good at running your company, like you say all the time. That's not our forte. But we're good at what we do in this sector. And if we don't know, we'll kind of find the right information.
So just on that thought as well, right? So essentially, I know we've discussed this before, but whose interests are you really taking care of?
Clients.
The client's interests. So you
Not
have
the
the
lender.
clients, not
Not
the
the
lender.
lender. Not the lender.
Okay.
The misconception is people go to a broker, they're going to charge me more. And a great example of this would be, why do people not use travel agents? Let this
Why
sink
do
in for you, yeah?
Okay.
Let this sink in. People don't go to a travel agent thinking the travel agent is going to charge a markup for their services, right?
Interesting. Yeah.
Oh, I can book this ticket myself, but the travel agent is going to charge me more. But the travel agent has access to deals that you can't get yourself, and vice versa, right? Or the travel agent may have preferential seats,
Or you end
upgrades.
up booking a hotel that you've never heard of before and you don't like.
Yep, or the reviews, then what do you do at that point, right? So you've got the wrong product then. So you've gone into a hotel, you've gone on holiday, but you've got the wrong product.
Because you have no experience in which hotels are good in
Right.
that area.
Same thing with finance now. Let's bring it back in. Now, finance side of things. You may have applied for a working capital loan, but what you needed was VAT funding, which is a lower rate of interest, it's paid back in a shorter period of time, and it's more beneficial for the
And
company.
it solves your issue.
And it solves your issue. Or your accountants advise you to go time to pay, which in theory makes sense. Time to pay makes perfect sense. But that's the accountant's equivalent of you booking your own holiday. He doesn't understand it completely, but he screwed you in the process. And I'll tell you why. You've gone to time to pay. Now you got a penalty point because you got a default with HMRC. So you're flagged as a late payer. Or do you, A, that's one option. B, speak to us, A to Z Finance, and me specifically, and we'll get you a VAT funding loan. You pay that same amount of VAT back, but we'll pay upfront for you, or the lender would, and you pay us back in a 3-month period. So as far as HMRC are concerned, you've paid all your debt upfront. Your VAT is zero.
Could they do the same with a corporation tax bill?
Corporation tax, yep. Self-assessments, we've got lenders out there.
Okay.
I don't give the advice, but we have special lenders who can do that for you. So this is how you offset big bills. So all I'm trying to say is, how do you offset a big bill?
Very interesting.
So back to the travel agent example, this is the benefit of coming to a broker. Can you do it yourself? Necessarily, yes. You could speak to these lenders, but will you present the case the same way? No. You won't know how to package it and build it and grow it.
I mean, if you think about it, right, like as a business owner, whether we're talking about, a mortgage or we're talking about a business finance product, right? Essentially, you're only going to go through the application phase once, maybe twice in your life, right? Whereas how many cases do you deal with on a weekly basis?
100%. It's a numbers-based game, right? So now we're doing these applications. We know what to look out for. Is it worth placing it with this lender because their appetite's changed right now?
Essentially, you're dealing with 100 cases a month, right?
It's a volume-based scheme, right?
Yeah.
So you could be a delivery driver, for example. Now, let's go back to that example, a delivery driver.
Okay.
Your average DPD driver or an Amazon driver out there does what? 100 packages a day. I wouldn't know where to start if I do 100 packages. I've got no idea how to plan a route or develop it, right? I'd be lucky to make 3 or 5. But these guys, it's their job.
Right.
You go to a delivery company for a reason. Could you deliver your own post? Yes. But you'd be traveling. You'd be up in another country all day long, wouldn't you?
Yeah, yeah.
Why'd you use Royal Mail? Because they're good at what they do.
Yeah, absolutely.
So we're pretty much that kind of equivalent. Outsource it to us. Let us do the right applications for the right people. We know what to look out for. We know the questions to ask. We ask also the other benefits. We know what not to ask for.
Okay.
Because there's an element of duty of care with a lender.
Right.
If you give them some information, they have to look at it.
Okay.
So if they don't ask for a particular statement or a particular transaction or a particular invoice, but you've submitted it and it goes against you, that's on you.
Okay.
But if they haven't asked for this information, then you have to submit it.
Interesting. So when someone speaks to you, they can speak openly, freely. They don't need to
100%.
worry.
It's like talking to your solicitor.
Yeah.
Like we're that kind of element. You don't hide anything from your solicitor, but you hide it from other people. So you got to keep that element of transparency and openness with us, so we can support you in the process.
Yeah.
And and the lenders will tell me what they're looking for. The lender may say we only want 3 months bank statements, but if you submit 6, but you've had a missed payment in month 5, that flags against you.
Right.
Or you've had some sort of cash flow challenging month where you went to an overdraft or whatever it would be. But that happened. Now there's a duty of care where they have to look at that information. If they haven't asked for it, don't give it.
Of course. Yeah, sure. I mean, yeah, end of the day, why would you, right?
But then people think I'll give you more information, the better it is for me.
Yeah. I mean, end of the day, I think what it boils down to is that knowledge gap, that inexperience, right? If you're speaking to a lender for the first time, going through any type of finance application, you wouldn't necessarily know what to submit, what not to submit, how to follow the process. And it can be quite a challenging, daunting task, right?
Yeah,
And I guess
definitely.
that's what really puts people off, isn't it?
And it's the handholding process of, okay, the lender may say we want this, this, and this, and you look at it and get panicked.
Yeah.
How do I get these HMRC screenshots, or how do I get my corp tax up to date bill, and all these weird and wonderful things?
So look, on the other hand, right, you've got a really stressful scenario where you're having to speak to a lender, you finally bit the bullet, you've thought, I need the finance, I've, called up a lender, and it's a difficult process, right? On the other hand, how is it coming to ATZ Finance, coming to someone like yourself, how is it?
We have multiple points of contact here, not just myself. Either speak to myself, speak to you, speak to Jade in the office. Some people is in the office to give you that sort of advice, an initial conversation. We're here to listen to you. Tell us your scenario. Then we'll come back to you with a solution. It won't be fixed.
Or a relaxed scenario, right?
Exactly that. It won't be fixed in one
Meet
conversation.
over lunch or something.
Yeah, there's elements of depending where the client wants to be.
Yeah.
Some clients may slowly open up, but it's all about transparency. What challenges have you got? Why have you got these challenges? Will they happen again? If so, let's work out a scenario. Or if you haven't got any challenges, great. Why are we talking then? What's your angle? Where do you want to be?
Maybe it's growth, maybe it's expansion.
Exactly. Yeah. Are you planning in 6 months' time? Perfect. Have the conversations now. Don't wait a week before you want to grow.
Perfect. And then start looking for
and
the
then
money.
start looking, right?
Yeah.
Don't look at, okay, I've got this big invoice coming in 3 months' time. How am I going to fund it? Okay, a week before it's due, I'll start making those phone calls. Get the line of credit sorted out now, or get the investment done now. It's a similar situation where someone's buying a commercial property or a residential property. You don't put the offer in, get the legals done, and then look for a mortgage. You go mortgage first, see what you can be approved for, and then you start finding equivalents to it, right? So this boils down to personal and business. But in your personal life, everyone knows the structure, don't they? To buy your own home, when you bought your first house or whatever, there was a process, wasn't there? You take your pay slips, you go to your mortgage broker or the bank, whoever you borrow your money from, and they tell you what you can and can't buy. You can't be a first-time buyer on 30 grand a year looking to buy a £5 million house. That just doesn't stack up, right?
Yeah.
They tell you your limits. Same thing in business. These are my books. What can we be? I want to expand over here. What's possible? What's not possible?
Interesting. You know, I think you're bringing up some really good points here. One of the questions I actually wanted to ask you was proactiveness and, you know, prevention in business, right? How important is it to do things early, kind of not stick your head in the sand? And this is exactly what you're saying, right? The earlier you can get through to someone, seek that professional advice, the better it is for the business. Am I right?
Definitely. Most people, and I'm not saying this is everybody, as a large percentage of businesses where the head is in the sand.
Okay.
Whether it's a simple thing like corporation tax, VAT, the insurance policies are about, they've got a couple of missed payments, and then they start looking for money. Or they've won a big contract, they don't know how they're going to fund it. The lads are being paid for. There's elements to go with it. You have to have a proactive approach. And what I mean by that is have facilities in place. Whether it's a business credit card, that doesn't have to be used, just have it there. If something was to, so this is the comfort zone bit where you kind of grow out of it, but you have facilities. They don't really cost you a lot of money, but they're nice to have.
Interesting. It gives you that kind of comfort zone, that buffer.
That buffer, right?
Right.
So why do people have a personal credit card? Why do you have a credit card? Prime example, right?
Yeah,
Why do you have a credit card,
it's
right?
no, really good question. So yeah, if anything ever goes wrong, if you know,
Unexpected bill.
yeah,
You've got a,
something happens.
You want to book a holiday.
Yeah.
Last minute getaway. You've seen a bargain, you're going to buy it, right?
Yeah.
You're on the options and the choices, right?
Exactly. If I wanted to go out and do a big purchase, I can maybe do that purchase knowing that the next 3 or 4 months,
60 days to pay off.
Yeah,
right?
yeah, absolutely.
An average personal credit card, you get 62
So
days.
let me ask you actually. So what percentage of businesses that you deal with, right? The business owner has a personal credit card, but the business doesn't have a credit
Oh,
card.
loads.
Really?
And these are small SMEs, right?
Right.
Corporates all have their, you might see them when you go out for
Company card.
company cards, whatever, right?
Yeah.
The average SME doesn't. What do they do? I use my debit card. It's easier. If I've got the money, I'll spend it. If I haven't got the money. But then now your accountant is sifting through pages and pages of transactions, right? And how do you separate what's business and what's personal? So we have this in our business. We have 2 credit cards. Got my personal and got a business card. So everything that goes on the business card is business related. So that's giving me an extra 30 days worth of credit. We don't need it, but it's giving me that buffer zone.
Of course. Yeah, yeah.
And a
So,
prime example is someone in the trades, electrician, plumbers,
yeah, you always pop into the
trades,
shops.
right? How many trades guys go to Screw Fix and all these guys, but they don't give you credit terms. Or you have to go in, you buy your stock and you do the job, right? Yes, a handyman's a prime example. So if you had a business credit card, you started working on the 1st of January, for example. You bought everything on credit card. That bill doesn't get generated until the 1st of February potentially, and you pay back 2 weeks later. So 15th, 16th of February. But you've done the whole of January, you've put on your credit card. You've got all that money in your own bank account. That one bill comes, you pay it. But then you've also done a bit of work in between February. So now you've given yourself a credit line.
Your cash flow positive.
You're cash flow positive. You've not borrowed from anybody. You're not gone to a business loan or anything else to go with it. But now you're giving your business a credit footprint.
Right. So an easy, simple way to start would just be a business credit card, right?
100%. Get a business credit card, whether it's through us or through your own bank, but get a business credit card.
Preferably through us.
100% through, always through us. We'll give you the advice to go with it. But get a business credit in the business name, not your personal name.
In the business
In
name.
the business name. And the reason why, like we said, the business is an entity.
Okay.
And most people relate to their business as a he or she. They put a gender on their business, right?
Oh, yeah.
Yeah, my business is my baby, right? There's always that element. So how do they grow it from there? So then now, how do you build that credit profile up for that business?
Right. So you're saying that having that credit card can demonstrate good credibility and can help you support your further cases in the future, right?
It shows that you can do something.
It shows that you can borrow money.
You can borrow money and pay back. You can borrow small and pay small. So
Perfect.
it's consistency is key.